Welcome back. Previously we have started performance measurement module in which we have briefly discussed about the concept and meaning of performance measurement and the two classification of measurement to measure the performance of an organization, and we have begun with return on investment. So let us continue with the methodological aspects of the return on investment. In the equation, the denominator is capital employed, and regarding the capital employed also there is a slight computation part, because capital employed can be gross capital employed or a net capital employed. So depending upon the requirement of the question, you have to identify what is meant by gross capital employed and what is meant by net capital employed. So let us go directly into the equation part. Gross capital employed is fixed assets plus current assets. I hope you have learned this part in the BCom sessions, so we are not going further into that area. And net capital employed is total assets minus current liabilities or fixed assets plus working capital. At the same time, net capital employed can be identified using total of share capital plus revenue reserves plus debentures plus long-term debts. Revenue reserves means usually it will be reserves, and long-term debts includes long-term loans, bonds, etc. And regarding average capital employed, in the equation it is capital employed, and we have learned gross capital employed and net capital employed. So what is the need for an average capital employed? Some of the experts in this subject claim that use of average capital employed is a better measure of return on investment. So in that case, you need to know how to find the average capital employed. Average capital employed may be calculated by dividing the sum of the capital employed at the beginning and at the end by the year by 2. So depending upon the need of the question, you may be using any of these equations. Depending on details available in the question, you might be using various cases, and if the question specifies regarding which method has to be followed, means regarding whether it has to be used on the basis of gross capital employed, or it is on the basis of net capital employed, or if it is on the basis of average capital employed, you need to use the equations accordingly. If no such specification is specified in the question, you can follow any method depending upon the details given in the question. So let us discuss about the merits of return on investment. Even though it is mostly accepted method for measuring the performance, it still suffers from issues as well as it has its own benefits. So let us begin with merits. The advantages of return on investment includes: it measures overall profitability, it measures success of business, it measures comparing the performance of different divisions of a firm. That is the main purpose of return on investment. Not only the measuring the performance of a division, it helps or enables the management in comparing the performance of different divisions and different departments of a firm. It helps in investment decisions. It is useful for planning the capital structure of the organization. It can be used for determining the price of a product. It serves as a foundation for the optimum utilization of the assets of a firm. So let us discuss about the demerits of return on investment. On the basis of merits, it has its flaws. First one, the concept is not clear, because here the return on investment computation is based on percentage. Usually percentage will not give a pinpoint result or information to the organization, even though it is helpful in decision making. When it comes to decisions that require pinpoint values, the percentage information will not be a helpful aid in decision making. So the concept is not clear. It is effective for comparison of divisional performance only when the different divisions follow the same accounting policies regarding valuation of stock, charging depreciation methods, etc. Sometimes the different departments might follow different methods of computation. For example, for computing depreciation, there will be 2 or 3 methods. If the departments follow different methods, then how can they compare? So that's an issue. Sometimes the divisional managers may reject new investments or projects that comes to that particular division or department, but that particular project could be a profitable for the company as a whole. From his point of view, it may not be profitable for that particular department, but sometimes in general sense, as an organization as a whole, that project might have been useful. So because of the decision of the manager, such projects and opportunities are lost. Decisions of divisional managers affect adversely. Because the divisional managers try to maximize return on investment of his own division without considering the overall value of the organization. In such situations, the actions that will have an effect on the organization as a whole will lead to catastrophic effects. It encourages managers to focus on the short run at the expense of the long run. Usually, return on investment analyzes short run activities rather than long run. But for the success of an organization, they must give importance to long run activities. Comparison is not always easy because when assets become fully depreciated, the measures of investment become very low. This makes the comparison very difficult. The ultimate objective of the return of investment is comparison. If it is not possible, then the whole purpose is in vain. So that is the concept of return on investment. So let us discuss about the next tool, residual income. Another method of measurement of performance of a division or a company is residual income. It is useful in overcoming some of the disadvantages of return on investment. The residual income is the difference between the net profit before tax and the desired minimum return on average capital employed. It is the amount of income earned in excess of a predetermined minimum rate of return on assets. All other things being equal, the higher the residual income, the better will be the performance of the organization. So let us discuss the equation for finding the residual income. Residual income equal net profit before tax, it is otherwise known as earnings before interest and tax, minus average capital employed into desired minimum rate of return. It can also be computed with another equation, net operating income minus average operating assets into minimum required rate of return. So these two equations can be used synonymously depending upon the details given in the question. And minimum rate of return, in the question they may specify minimum rate of return or return on capital. It's all synonymous to the term cost of capital. I hope you know what is meant by the cost of capital. So usually the minimum rate of return is the cost of capital. Therefore, any surplus automatically represents residual income. In short, residual income is the excess of income from operations over a minimum desired income from operations. The minimum rate is set by top management based on such factors as the cost of financing the business operations. If the residual income is greater than zero, then the division or the company is earning more than the minimum required rate of return. At the same time, if the residual income is less than 0, then the division or the company is earning less than the minimum required rate of return. So that is a scale for, or the yardstick for, measuring or interpreting the situation of a concern. Remember, these yardsticks or standards. You need to interpret the results depending upon the details given. So let us discuss about the merits of residual income. Even though it was introduced so as to overcome the flaws or demerits of a return on investment, it has its merits as well as demerits. So let us go through the merits of residual income. First one, it expresses the income in absolute value rather than a percentage value, because in some situations actual value is more favorable for decision making. It considers both the minimum desired rate of return and the total income earned from the operations. It encourages managers to maximize income from operation in excess of the minimum. This provides an incentive to accept any project that earns the above minimum rate. So it facilitates quick decision making. It allows different rates of return for different divisions. Investment decisions taken by different divisions are compatible with the overall objective of the organization. So these are the merits of residual income. So let us discuss in detail the demerits of residual income. It is an absolute measure of profitability. Thus, direct comparison of performance of two different divisions become difficult. This is because the level of investment may differ. In such situations, percentage analysis is better. Problems may arise with regards to the choice of an appropriate minimum rate of return. Which rate of return has to be accepted as a yardstick? That is an issue within the organization. Sometimes the return on investment may be low in the first few years. As a result, a potential investment proposal may be rejected due to dissatisfactory residual income in the initial year. So, even though the residual income has an advantage of quick decision making, sometimes quick decisions reject potential projects. The concept of net operating profit and investment are not clearly defined. Even though it is specified that it is using net profit before interest and tax, it is not giving a clear picture regarding what all non-operating items has to be considered or not in order to get the operating profit. They are not specifying in detail or pinpointing in detail that are the areas or items that has to be considered while computing operating profit, as well as regarding investment. Whether it is an gross investment or a net investment, no such information is given. It always encourages short-run orientation. For the success of business, they have to consider short-run as well as long-run, and at the same time, long-run is more important than short-run, even though both are required. So these are the major demerits of residual income. Even though it has evolved as a correction for a return on investment, let us discuss about some of the comparison and difference between return on investment and residual income. Comparison between return on investment and residual income. The main similarity is that both approaches consider operating profit and investment. If you go through the equation, you can understand that. Both methods encourage short-run orientation. If you go through the demerits, you can see that both considers and encourages short-run orientations. So these are the main comparisons or similarities between return on investment and residual income. So let us discuss the differences. Always return on investment is a percentage measure, while residual income is an absolute measure. When return on investment approach is used, the problem of overinvestment and underinvestment may arise. But there is no such problem under return on residual income approach. Finally, return on investment is independent of ROIs. It is better suited as a comparative measure, whereas residual income is more useful as a performance measure for a single investment center, and comparison is not much entertained in that area. So these are the major differences between and similarities between return on investment and residual income. Apart from going through these slides, try to refer more text and other sources to identify and have an in-depth knowledge regarding these tools. We are just going to the glimpse over the area of various tools. You have to be very thorough and proficient in these tools. For that, you need to refer other texts also. Don't always rely on these slides alone. Just go through other texts. Preferably Financial Management Theory and Practice, author Shashikeet Gupta. Try to refer that text, and apart from that, try to refer more text. We will discuss about the further cases in the next session. And remember the equations for each method as well as the standards for each method. For each method, there will be a standard regarding how to interpret the results. So familiarize each standards, familiarize each equations. We will discuss in detail the further tools in the next session. Thank you.